Imagine you have $100,000 sitting in your retirement account. You don't know whether you're invested too aggressively. You don't know whether you're saving enough. You don't know whether you should pay down your mortgage or invest more. So you do something that would have sounded ridiculous a few years ago. You open ChatGPT and ask, "What should I do with my money?" In the US, 45% of consumers say they've used generative AI for a financial question in the past year, and 67% expect AI to influence their next borrowing decision. AI can explain a Roth IRA in seconds. It can compare investments. It can even tell you what it thinks you should do. But should you trust it with your financial future? Because the most interesting part of this story isn't whether AI can replace your financial advisor. It's what happens when financial intelligence becomes almost free.
Chapter 1. The Financial Advisor in Your Pocket. For decades, financial advice had a friction problem. You had to find an advisor, make an appointment, explain your finances, possibly meet minimum investment requirements, and, depending on the service, pay for the advice. Now compare that with AI. It's 2 a.m. You're wondering whether you can afford a house. You type, "I make $95,000 a year. I have $30,000 saved, $20,000 in student loans, and I'm planning to buy a house in 4 years. What should I do with my next $1,000? And seconds later, you have an answer. No appointment, no embarrassment, no minimum account size, no waiting. And that matters, because the first market AI is disrupting may not be the market for wealthy people who already have advisors. It may be the enormous group of people who never had access to personalized financial guidance in the first place. Using AI to extend financial guidance to more investors while keeping human judgment for higher value conversations. That's a much bigger idea than AI can pick stocks. It's this. AI is dramatically lowering the cost of asking for financial help. And once advice becomes cheap, more people can participate.
Chapter 2. People are already using AI for money. And this isn't just speculation about the future. 67.8% had used an LLM for at least one financial task. The most common uses included stock investment and portfolio choice, savings planning, budget management, and tax planning. People aren't just asking AI, "What does diversification mean?" They're increasingly asking, "What should I actually do?" And that's a completely different level of trust. AI is moving from being a financial dictionary to becoming a financial decision assistant. And that's where things get interesting. Chapter 3. AI is often giving reasonable advice. You might expect an AI model to be terrible at personal finance. After all, it's a language model. It predicts text. It isn't a licensed financial planner. So you might assume it would tell everyone to buy the latest meme stock. But recent research paints a more nuanced picture. Stanford and MIT researchers tested AI-generated financial advice using real human-written prompts and simulated people's financial lives over time. They found that LLMs generally nudged people toward behaviors economists have traditionally considered sensible: spending less, building savings buffers, investing in stocks, and eventually shifting towards safer assets later in life. In some simulated scenarios, people following the advice accumulated substantially more wealth than the observed people who wrote the prompts. That's surprising, because AI isn't necessarily producing some magical investment strategy. It's often doing something much simpler. It's telling people to save more, diversify, think long-term, and avoid running out of money. In other words, AI may already be pretty good at giving people the advice they know they should probably follow. So where's the problem? Chapter 4. The question may be more important than the answer. Here's one of the most interesting findings. The Stanford MIT researchers found that the quality of the AI's advice varied substantially depending on the prompts people wrote. People with lower financial literacy tended to provide less information about their circumstances, and that resulted in less personalized recommendations. The simulated users following those weaker prompts ended up nearly $50,000 poorer by age 60 in the researchers' model. Users who were inexperienced with LLM financial guidance ended up nearly $100,000 behind those with more experience. Think about how strange that is. Two people can have access to exactly the same AI, same model, same technology, same question. How should I invest? But the person who knows how to explain their income, tax situation, debt, risk tolerance, time horizon, cash needs, and financial goals can potentially get a much better answer than someone who simply asks, "What's the best stock?" So AI doesn't necessarily eliminate the financial literacy gap. It can move the gap upstream. Before, who has access to financial advice? Now, who knows how to get useful financial advice out of AI? That's a very different problem.
Chapter 5. AI could actually make financial literacy more important. Here's the paradox. You might think AI makes financial knowledge less important. Why learn about tax-advantaged accounts if AI can explain them? Why understand asset allocation if AI can build one? Why learn about mortgages if AI can compare them? But imagine AI gives you this answer. You should increase your equity exposure. How do you know whether that makes sense? Are you 25 or 55? Do you need this money next year or in 30 years? Do you have an emergency fund? Are you carrying high-interest debt? Could you tolerate a 40% portfolio decline without selling? The AI can give you an answer, but you still need enough knowledge to judge whether the answer fits your life. This is where the concept of automation bias becomes important. When a system looks intelligent and authoritative, people can become too willing to trust its output. And the financial consequences are much higher than making a bad restaurant recommendation.
Regulatory reports specifically flags AI risks, including hallucinations, bias, outdated or skewed data, privacy issues, and insufficient domain knowledge, and says firms need testing, monitoring, and human oversight around AI-generated outputs. So the future probably isn't AI knows everything. It's AI can generate extremely useful financial information, but someone still needs to decide whether it is appropriate. Chapter 6. And there's another problem. AI doesn't necessarily agree with itself. Here's something most people don't think about. There isn't one universal concept called the AI answer. Different models can give different recommendations, and even the same model can produce different answers depending on how you frame the question. Academic research comparing professional advisors with LLMs found that AI advice was more conservative than the advice given by human financial professionals in the study. That might sound safer, but being more conservative can also mean giving up some potential long-term growth. And that's where things get really interesting. Because when you're dealing with your money, there isn't always one objectively correct answer. One system might prioritize protecting your downside. Another might put more weight on long-term growth. A human advisor might look at the same situation and make a completely different judgment. So you can ask 3 systems the same question and get 3 different answers. Not because one of them is necessarily broken, but because financial decisions depend on assumptions, risk tolerance, time horizon, and what you're actually trying to optimize. And that brings us back to the title of this chapter. AI doesn't necessarily agree with itself. So the question isn't, which AI gave me the right answer? It's, do I understand why these answers are different? Because once AI becomes your financial assistant, knowing how to evaluate the answer may become just as important as getting one. Chapter 7. The advisor isn't disappearing. The job is changing.
And the financial industry seems to understand this. Morgan Stanley says more than 98% of its advisor teams actively use its internal AI assistant to retrieve firm knowledge and help serve clients. Vanguard is also explicitly positioning AI as something that can extend advice while allowing human advisors to focus on higher value conversations. So the likely future isn't AI versus financial advisor. It's more like AI handles the information layer, and humans increasingly handle the judgment layer. Think about the difference. AI can explain, here's what a Roth IRA is, but a human can ask, why aren't you willing to take this job even though it pays more? AI can calculate, here are 5 possible retirement scenarios. A human can say, you're probably going to panic and sell when the market falls. AI can compare, these are your mortgage options. A human can help you navigate divorce, inheritance, family dynamics, business ownership, concentrated stock, tax complexity, and decisions where there isn't one mathematically perfect answer. The more AI handles information, the more valuable judgment may become. Chapter 8. So what should you actually use AI for? AI is potentially extremely valuable for the first layer of financial work. Use it to explain concepts, build a budget, stress test scenarios, create a list of questions for your financial advisor, translate financial jargon into plain English, run what-if scenarios. For example, if I increase my monthly investment from $500 to $800, how does that change the long-term outcome under different return assumptions? That's a fantastic AI use. Or, here are my monthly expenses. Help me identify recurring costs that are fixed versus discretionary. But be much more careful when the question becomes, tell me exactly what I should buy. Because that crosses from education into decision-making. And the consequences of getting it wrong are real.
Chapter 9. The real competitive advantage may be the person asking the question. This is the insight I want you to remember. AI makes financial knowledge cheaper. That means the value of simply having information goes down. And when information becomes abundant, something else becomes scarce. Good judgment. Everyone can ask, what should I invest in? Far fewer people can ask, here is my actual financial situation. Here are my constraints. Here are my goals. What assumptions are you making? What could make this recommendation wrong? And what risks am I overlooking? That's a completely different level of financial thinking. And it leads to an interesting future. The best AI-powered investors may not be the people who know the most answers. They may be the people who know which questions to ask. Ending. So the next time you open ChatGPT and ask, what should I do with my money? Don't stop at the first answer. Ask another question, then another. Challenge the assumptions. Ask what could go wrong. Ask what information is missing. And most importantly, don't outsource the decision simply because you outsource the calculation. Because AI may be able to tell you what the numbers say, but your financial life isn't just numbers. It's your career, your family, your risk tolerance, your goals, your psychology, and your future. And no algorithm knows those better than you do. If this video made you think differently about AI, money, or financial advice, consider subscribing and giving the video a like. And tell me in the comments, would you trust AI with your investments, or would you still want a human advisor? Because the answer to that question might shape the future of financial advice.